Hello, everyone. Welcome to another episode of Learn ETRM, where we explore the energy and commodity markets through conversation with industry leaders. I'm your host, Ranjan.
Hi, and I'm Chirag. Today, we are delighted to welcome Arne, Chief Analyst and Head of Research, Global Risk Management, widely respected person in geopolitics, oil prices, and global energy markets. Arne, before we dive into our questions for you, and thank you for coming on this special episode. Could you just briefly introduce yourself to our listeners and how you started off in this wonderful journey in the energy markets?
Thank you, both of you, and thank you for the invite. It's an honor. My name is Arne. I work for this company called Global Risk Management. We normally just call ourselves GRM. It's a bit easier. We are placed out of Denmark, but we also have an office in Singapore, and we are represented in Norway, Sweden, in Houston, and we have sister companies in Dubai. We are part of a group called Bunker Holding, which is actually the biggest supplier of bunker fuel to the to the bunker industry, to the maritime industry. But GRM is a financial company. We are regulated by the Danish FSA, and what we do is we do hedging with corporate clients. Of course, we have a lot of clients in the shipping industry, but we also have clients in industrial sector, airlines, power producers, biogas producers, biodiesel producers, oil producers, everything that is related to energy. We just moved into grains actually because we're also quite active in biodiesel. And I work there, as you said, I'm the chief analyst. So what
Wonderful.
we do is I do research for our clients, for our traders, for our sales, and we try to give an advice, try to use it as a discussion with clients that are considering hedging. Is it a good idea to hedging? What hedge ratio should you use? Where on the curve does it make sense? What product to use, a swap, a futures, options, whatever. We only work with corporate clients. I think we're a bit different from, for example, banks there, but in general, we compete with banks. We do not work with sort of hedge funds and so on. We're very focused on this segment of the of the curve or the market, so to speak. And myself, I've been with the company for a bit more than 3 years. And then for many years, I worked for the biggest bank here in Denmark called Danske Bank, covering various assets like FX, fixed income. I did a bit of ESG, and I also headed the commodity research unit there. But commodities was actually closed down at the bank some years ago, and it's actually a development we have seen also in other banks. That banks are not so keen on being active in the derivatives markets, or a paper market as we call it for commodities. But of course, there are still many banks out there being active, but some have left, including where I used to work. I'm an economist of education, but it's a few years ago now. So I've had a long experience with mainly energy, but of course also other assets and macro in general. So I try to use this in my daily work.
Thanks, Arne. That context is really helpful, and it's an impressive background. So building on that, oil prices today are shaped by complex mix of geopolitics, macroeconomics, OPEC decisions, and the evolving demand patterns which we see. From your perspective, what are the key drivers shaping the oil prices right now? And which of these should the traders and risk managers focus the most on?
Yeah, first of all, in oil is like any commodity. It's a question of, I guess, of supply and demand. But it's not that simple when it comes to oil, because there's also an important geopolitical angle to this, or you can also say expectations. And why is geopolitics very special or very important for oil? Isn't it important for copper, aluminium, grains, or whatever? it is, I guess, important for oil because oil, whether we like it or not, are produced in areas where we historically have seen a lot of political uncertainty. It is the Middle East, it's Russia, some of the Latin American countries, and maybe even today the US. If you could add that, that would be a surprise, but that's maybe where we are. And it's also at the moment a very important. It is the most important commodity we have in the world. There's always oil you look at, and I guess a very good example is when Russia went into Ukraine. How could you sanction from Russia for doing this? Then you looked at their oil income when Trump decided to take out Maduro in Venezuela. Oil, of course, played an important role. But I guess at the moment, what's the key driver for oil prices? Of course, geopolitics are important, but it's also important what happens with supply and demand. At the moment, there are probably an oversupplied market. Supply is, of course, also a bit special in oil because you have the OPEC, and of course the power of the OPEC or the OPEC plus today, of course, varies from year to year or even month to month. So of course there's a number of factors. In some periods the dollar is very important. What happens with the value of the dollar? It seems at the moment it doesn't matter that much. So I would say today. Demand picture, inventory building, sanctions / geopolitics, and of course OPEC are some of the important drivers we focus on. It is also from time to time just an integrated part of financial markets. In some periods you can actually wake up in the morning and you can look at the S&P future and say, okay, it's pointing up. Oil will probably also be up or pointing down. It doesn't seem to work that way at the moment. That we have seen a kind of a decoupling, and then it's a commodity where you, from time to time, in my view, have a lot of you can have a lot of volatility, and in periods you have actually less volatility. And I think that's special, of course, for many commodities, that either there's enough of it or there's not enough. And given what you call the price elasticity is low, meaning that you'll need oil whether the price is very high or low. If demand is not impacted by the price has to go up a lot, and we see that typically in commodities. At the moment, it doesn't work that way because there's enough oil, and then basically the price of oil is kind of equal the marginal costs. That's a very economic approach, but I think that's where it changes. It's very important, I guess, as an analyst to understand where are we on this supply and demand curve, because it tells you a lot about how will the market react to, for example, geopolitical events. If we look at the last year, there have been so many geopolitical events. What has happened? We've moved up a bit and the market has faded. And basically, I guess it reflects that there has been enough oil in the market, and then geopolitical events cannot drive it over a longer period of time. You can, of course, drive it from day to day, week to week, but not over a longer period of time. I don't know if that makes sense. That's very sort of probably my economic background that comes in there.
Yeah. No, absolutely, Arne. And for I was reading a book. It said the thing which distinguishes a good trader between a good trader and a great trader or an analyst is there may be 1,000 indicators, but a great analyst knows which are the top 3 to focus on
Exactly.
that particular day.
It's like I actually often say, what is my most important job? That is basically to sort of separate between all, because there's an information overload out there.
Absolutely.
You cannot focus on everything. So we try to sort it out for our clients, basically say, okay, at the moment you should focus on this and not that, and so on. I guess most people try to do that, but there is so much information overload there. You cannot read everything. You cannot understand everything. And but of course, a good analyst is the one who can understand when it changes to something new. At the moment, we don't focus a lot on euro dollar or the dollar in general, but maybe that changed tomorrow for some reason.
Indeed. For the new listener, Arne, they come across words like contango, backwardation. Can you just briefly introduce them to what those words mean? What are those definitions in the energy business from your perspective?
I guess if you are active in the energy market, oil market, and oil product market, that's of course a lot of lingo. One of the strange thing is that if you have a curve, a forward price that is above the spot price, you say that the curve is in contango, and if the forward price is below the spot price, the price of oil in the future, then you say it's in backwardation. And then people always ask, can I use the forward curve to predict the oil price? For example, the forward curve says that the oil price will go down in 4 months time, and then will start in 2027 actually to go up again. I think people should be a bit cautious about that. It gives you an indication where the market is seeing oil. If you look at forward curves over time, they are actually a very poor predictor. That said, analysts are also in general quite poor at predicting the oil price. But that is a key. Understand this is backwardation, lower forward prices, contango, higher forward prices. And you would think, oh, you must have contango, higher forward prices when the market is thinking that the market is very tight, prices will go up, but it's actually the other way around. Contango is actually a reflection of an oversupplied market, because contango reflects that the spot is pushed lower, and then the market saying it will go higher in the future. It also reflects that people don't want to own oil today, so they're pushing down the spot price. It's actually become quite extreme. For example, during the pandemic, remember, I don't know if you remember, but WTI was actually negative.
Negative, right.
I think for only a few days or so. It shouldn't be possible that you actually are paid to receive something, maybe a gift from your mother-in-law, I don't know. But it actually reflected that it was a very special situation. There was no storage capacity in Cushing, Oklahoma, where you have that sort of physical delivery. But it also reflected that nobody really needed the oil here and now, and you had to store it. And to store it, you have to hedge it, and someone to store it, you have to find someone who will pay a bit more to receive it in the future. You can actually, in such a situation, make quite a bit of money if you're able. If prices are very depressed, you have this very strong contango. You can buy it today, keep it in your storage, or hire a tanker and store it there, and then you can sell it forward, let's say in 6 months' time, at a higher price due to the contango. And then if the higher price can actually cover your cost of storage, the cost of storage is of course storage cost, storage rent, and it's also financing. You have to finance the oil you're having on your in inventories or on a ship and so on. But during the pandemic, for example, you could make a lot of money on that. During the financial crisis, you could make a lot of money. So contango is a bearish sign for the market, telling you the market is oversupplied. Backwardation is a bullish sign, saying that people are rushing to get hold of commodities or oil at the moment, so they're bidding up the price here and now.
Interesting.
So, and that's all, of course, also some kind of normalization in this. When prices were 140 before the financial crisis in 2007, you had a very strong backwardation, because the market said that, okay, $140 for a barrel of oil, it's insane. Prices will be lower, but you had to buy it because there was a lack of it. But people were ready to sell it in the future at a lower price. For example, if you're a producer, you thought, okay, it's okay, maybe I can actually lock in my oil in 1 year's time at 100 or 120 or whatever. It's still a very good deal. I will do that. And it turned out to be a good deal from a producer point of view, because as we know, prices collapsed when the financial crisis hit. So yeah, a lot of this lingo, but it's not that difficult. It's much worse when I worked in fixed income. That was a nightmare.
Thanks, Sunny, for explaining all these terms so well for our audience. So in addition to fundamental and market structure, financial flows play a bigger role in the oil markets. Recently, we have seen a significant Brent buying linked to the index tracking and rebalancing by the investors. How do investors positioning or index tracking or rebalancing flows influence the oil prices? And to what extent?
So
and how much it can distort the traditional pricing signals for the traders and the risk managers?
I think the simple answer is we really don't know. There's a lot of research done of this, and some say it has an impact, but theoretically, a future is just a bet on where the price is in the future. It's like betting on a football match. Does that impact the result on the football pitch? No, it doesn't, or at least if there's no rigged or anything. But on the other hand, of course, financial player in the futures market, if they're the physical market, it's a different thing, right? Because then they actually take out oil, store oil, take it away from the market balance. So, but if we only stick to the paper market or the futures market, it can still have an impact, because if you have a future, someone is on the other hand side, and in the end, there's a physical delivery, or you have to take on the oil if you are on the other side. So it is connected to the physical market, and that's also the reason why, in reality, it shouldn't be able to impact the market. That said, that's a very theoretical approach. In reality, of course, it has an impact, and sometimes it can be pretty significant. I'm pretty sure when oil prices was close to 150 there in 2007, some of it were speculative driven push higher in prices. At the moment, we have seen oil prices moving higher. We all look to Iran, Venezuela, geopolitics to explain that. But maybe it is, as you say, Ranjan, just a reflection of there's quite a big financial flow going through the market at the moment. Maybe I should just explain this index tracking, balancing, rebalancing, what it actually is about. If you're an investor that sort of tracks, if you decide I want to track the performance of the commodity market, just like I track the performance of the S&P 500 or whatever, you can follow an index. Bloomberg has one, S&P, Goldman Sachs has another index. And basically what you do there, then you buy a bit of gold, you buy a bit of agriculture, you buy a bit of Brent, you buy a bit of US gas. I think it's only in there, a bit of metals, of course. So you buy a basket and you're sort of diversified. And what happened last year? And who said these weights? And that is done by the index provider, S&P Global or Bloomberg, the two main indices. And they say that, okay, oil is that important in the world. Metal is that important, gold is that important, and then they have a weight of that. But let's say we go 1 year back to the start of 2025, and you bought this basket. What did you end up with at the end of the year? You end up with more money. But what does your return come from? It came from especially metals, but especially from precious metals like gold. And it didn't come from Brent, because Brent was actually falling throughout 2025. So you end up in a basket where you actually have the value of have an overweight of exposure to gold and an underweight of exposure to Brent. And then every year, these index providers, they rebalance, and then they say, okay, given that gold is so much higher now, it will have a lower weight in the basket. Otherwise, gold will be far too important compared to the real macro impact it has on the global economy. But oil, the value of oil in the basket is too low because oil prices have come down relative to oil. So we revise that weight higher. And then the index trackers, the investors see this and they, okay, if they still want to follow the index, they have to sell gold and buy oil, Brent. So that actually triggers, and that will end. It's the 50. That's actually the last day today. That will change in today. So index trackers have been selling gold, buying oil. You can say, does it really have an impact? Because people can actually figure this out. It's not rocket science to figure out what happens with these weights. And of course, people have been doing this. They've been sort of preparing for this. You can also say front running. It's been maybe some have been selling gold in anticipation that the price would go down, and vice versa. Of course, that's one way speculators can impact market. I think the most important is basically people investing directly in an oil future because the price, or an oil curve trade or anything, because they have a view that the price will go in one direction. During last year, we saw investors actually being bearish, positioning for lower prices. I think we're seeing a turnaround now that more and more investors are betting on higher prices. Could also be why prices have been a bit higher this year. And it could also be a reason why I think we've seen a support for Brent at around 60 many times. And I think a lot of investors coming in at 60 saying that that's actually an okay level to buy at. We also see our corporate clients coming in when we are at $60 saying that that's okay, a very good level to hedge our exposure on the consumer side. We actually have a pretty good overview of what investors are doing. If we trade on the ICE, for example, or the NYMEX, we actually have to tell, why did you do this futures trade? Was it because you had a corporate client? Was it for your own book, or was it a hedge fund, an investment funds behind it? And then we basically look at what are the investment funds, the speculators doing, because it gives them an idea of how the market is positioned. Some say you should follow the smart money. If they're buying, you should buy. If they're selling, you should sell. I actually like to look at it in the way that if a lot of speculators have been buying, it's probably time to go the other way, saying that now the market is overbought. They're just looking for an opportunity to take profit. Then we should be a bit careful. If everyone is short, then we could actually have what you call short covering. I guess that was what happened. For example, yesterday when there was all this fear that Trump would bomb in Tehran and it would spread. Oil price started to rise, and I guess if you were short oil, you got a bit scared there, and you closed your short position and ending up buying oil futures, right? Because when you close a short position, you do the opposite. Then Trump didn't bomb in Iran and so on, but it actually it can add to volatility, especially from day to day. But I firmly believe that investors, speculators cannot drive the oil price over a longer period of time, but they can certainly create from day to day, week to week, maybe month to month, and especially during a day. It is important what they are doing. So we have data both from the NYMEX and the ICE. We have some exchange traded funds, that retail investors are doing. We can see are they adding to the asset under management or not. Also give you an idea if this is popular. But in general, investing in commodities is far less, in my view, far less important than it was, for example, before the financial crisis, where I was also promoting this to institutional investors. Many of them are not really active in commodity investment as such, but of course there are still a lot of hedge funds, also end user monies that are active, but it was much bigger in my view relative to the market in 2006-7.
Arne, did you say that previously there was lower interest in the market?
No, higher. In my view, it was higher. For example, in 2006, 2007, they played a more important role. And I would say it was probably one reason why oil went so crazy in 2007, hitting these, 145. And you can say, if you're a hedge fund, what do you look for? You look for volatility. And of course, oil can offer that. But volatility has come off over the last year. It's a part of this we talked about, that if you have a market that's well supplied, you don't see these spikes on geopolitics, maybe $3, $4, $5. It's a big move, but the market, as you call it, faded, and then prices edge lower. Again, if you have a very tight market, the moves can be much bigger, both on positive but also on negative news.
Speaking of volatility, Arne, and oil, it's hard to have a conversation without talking about OPEC. So I wanted to ask you, do you see OPEC Plus acting more as a stabilizing force or adding more volatility in the next 6 to 12 months?
I think they're trying to keep a relatively stable market. but maybe to a lesser degree, because I think they have moved from being a very focused on the price. You say a price above market equilibrium, but last year it's my view that they changed their sort of objective from being a price target to a market share target. They basically added quite a bit of oil last year to keep the market share. And who are they competing with? They're competing with, of course, the U.S. shale oil production, but they're also competing internally because especially for a country like Kazakhstan has been breaking their quotas. So to make sure that those who comply with the quotas don't miss out on market share, I guess the UAE and Saudis decided, okay, we cannot control a country like Kazakhstan to a certain degree, Iraq, they're adding too much oil. Okay, then they have to feel the pain. We'll add more oil also, even though it means lower prices, but we can live with that. But I think at the moment, I think they're trying to draw a line in the sand around $60. We saw that last year when they decided to take it. Remember, during last year, they added quite a bit of extra oil to the market, and the plan was it should continue this year, but they actually decided to take a pause in Q1, not adding more oil. The excuse was that it's seasonal weak demand in this quarter. Of course, they knew that when they put out the plan. And I don't think they will add more oil this year. There's simply not room for more oil.
Well, there are a lot of things which are happening in the world of oil right now. There is a lot of uncertainty. So in that, let's turn to Venezuela. The country has seen a significant political development right now, recently, alongside US engagement. However, it has the largest oil reserve, but it also comes with its own set of challenges, like infrastructure challenges, underinvestment. So given the current political situation, how should market participants interpret Venezuela in the next term? What should be the outlook? And also, what is realistically achievable here in next 12 to 24 months?
I think if we start with Venezuela, as you said, they probably have the biggest reserves. You could always discuss in the world. Discuss how large are they? Are they a bit too optimistic? But never mind. But they are, of course, for the market, the next couple of years, it is the amount of production that is important. Because as long as the oil stays in the ground, it doesn't really matter in that way. And Venezuela is really a sad story. They produced 3 million barrels 25 years ago. They produced even more in the 70s. But as you said, due to mismanagement, corruption, sanctions, and so on, oil production is now somewhere below 1 million barrels, so less than 1/3 of what they produced 25 years ago. Now we have the US in, and as Trump said, they basically control or run the country, and especially they control the oil sector. And they would like to have a higher production to make more money. We can always discuss where the money will end up, but no, it's obviously that they would like a higher production. I don't know if you saw this meeting with oil CEOs in the White House. Was it last Friday? I think Friday, I guess, last week. And if Trump thought that this was just going to be a walk in the park and it's going to be very easy to add to production in Venezuela now when the sanctions are basically removed, it may not be that easy. We saw the ExxonMobil CEO saying that that Venezuela is basically uninvestable. He said that they have already burned their fingers twice. They were nationalized in, I guess, in the 70s when OPEC was created. Venezuela was actually one of the founding countries for OPEC. And then they were nationalized again during Ahuja. And they're a bit cautious moving in again. Are producing in Venezuela. They produce like 1/4 or 1/4 of the production there. They are happy to invest more and add to production. Some smaller companies are happy, but I guess what people were left with after this meeting in the White House was that the oil sector in the U.S. are not going to rush into Venezuela to invest. There's simply too many problems. One is, of course, corruption, the risk of nationalization in the future. Who knows who will be president in Venezuela? Maybe after Trump, there will be another president in the U.S. that doesn't think that the U.S. should run Venezuela, as Trump says. So the political risk is huge. It's not that easy just to invest. There are, of course, some low-hanging fruits, and I think they will try to fix that. That could add industry specialists, say maybe 2, 3, 400,000 barrels of oil extra a day. That's still 30, 40% compared to today, but it's still far away from the level 20, 25 years ago. And that could actually come in maybe in less than 12 months and definitely in 2 years time. But if we're going back to the 3 million barrels per day or more, it will take a long time. It will take huge investments. I hear numbers from $100 billion to, I think, 187 billion is a number I've heard that it will take.
Wow.
Are the oil companies really ready to do this? Maybe there are other places where it's better to invest. Maybe in Guyana, the neighboring country, which is a kind of much more stable country, and mobile is already. Yeah. Then there's the oil price outlook. At the moment, there's plenty of oil on the market. And if we are moving towards a green transition, maybe we don't need the same amount of oil in the future. There's still more oil coming out of the U.S., coming out of Brazil, coming out of Guyana. It's not obvious that the world needs 2 million barrels of extra oil in 5-10 years time. So that's another risk to this. And then finally, it's also quite heavy, quite an expensive place to invest in. It's much cheaper to invest in, for example, in the Middle East, where you basically just put in a straw into the sand and then oil comes out. It doesn't work like that in Venezuela. It's a heavy sour stuff. I don't know if you're familiar with heavy sour crude oil, but it's really, really thick. And if you put it in a bottle, it will not come out if you turn the bottle around. And you actually have to dilute it with naphtha, a chemical product, for it to be able to run through pipelines. And that's another thing. It's not just that you have to invest, but the whole infrastructure is basically run down. So you need to also invest in pipelines, infrastructure, shipping facilities, in ports, and so on. I heard that today you can take a VLCC, this very large crude carrier. It takes 5 days. 25 years ago, it could do it in 1 day. It just tells you how run down things are in Venezuela. So I doubt they're ready to invest all this money. It's a sad thing for people in Venezuela, but I guess that's the reality. And it's also, you can say, if the U.S. oil companies are just allowed to take all the money, it will of course be more profitable. But if they do a deal like that, they also know that the risk of being nationalized in the future is of course growing. You have to do fair deals, otherwise it will not work in the long run. And I guess the Trump administration doesn't really understand that, are not willing to understand. But the oil itself is heavy, thick, difficult to handle, and it's cheap because it trades with a discount of $15, $16 to Brent. It competes with the oil from Canada. It goes to it used to go to China by the shadow fleet, and now the plan is to use it in the refineries on the U.S. Gulf Coast, which are actually set up to handle this oil. These were set up long before Hugo Chavez and Maduro came to power in Venezuela. So in that respect, the infrastructure for refining this heavy sour crude oil is in place, but it trades with a discount because the value of the products that comes out of the crude are lower. They're simply coming less out of the attractive products like gasoline, diesel, chemical products. What I'm missing, and what is coming out a lot is it's bitumen, asphalt, and it's residual oil that we trade quite a bit of that in the maritime sector, because that is what you use for what you call bunker fuel. That is actually from the residual oil market, high sulfur fuel oil. You can use that in a ship. If you heat it up, you can burn it, but you also need to have what you call a scrubber on the ship to take out the sulfur content, which is very damaging for the environment. But if you have on a scrubber, you can use it. And there's a world agreement on not to use this oil without a scrubber. Yeah, so actually, as I said, we quite big in the maritime sector. There's you can say the direct impact on oil prices from Venezuela has been relatively muted. If you look at a chart for a year ahead, you will not be able to see, okay, that was the day they took out Maduro. But there's one market you can see that in. That's actually in the what you call high sulfur fuel oil,
right?
Which is this residual oil prepared for the bunker industry or for use in power industry. You can burn it to produce electricity. That price has gone down in Europe because now we will have access to, you can say, non-sanctioned residual oil from Venezuela, but the price is actually going up or not falling to the same degree in Singapore, which are the two main hubs for shipping. Because in Singapore, the high sulfur fuel oil used to come from China because China was refining the heavy sour crude oil from Venezuela. Suddenly, the oil is not going to Venezuela anymore. So basically, what has happened is that the oil from Venezuela has moved has changed from being sanctioned oil to being non-sanctioned oil. So now it's available in Europe, and it doesn't go to China anymore. That's probably the market where we are seeing the biggest impact. And there's also some impact on the price of Canadian oil because they're competing with each other.
Yeah. So, there is a saying in India. So if you burn your tongue by drinking a hot milk, you drink even water so cautiously. So I think that's the situation with Venezuela right now.
I guess, yeah, that's a pretty good picture of that.
Yeah.
In Danish, we say something like, burned child is afraid of the fire or something like that.
Yeah, and so you throwed some light on the Canadian. So I come from Alberta, so I'm based out of Alberta right now in Calgary, and so we have a lot of oil sands, and the oil grade is very similar to what it is in Venezuela right now. And U.S. refineries, as you rightly point, were made to refine the Venezuelan oil and then eventually the Canadian oil as well, because it's a very similar viscosity and grade in that sense. So how do you see impact on the Canadian oil industry here?
Yeah, but it is, as you said, it's a new competitor for the market because they didn't used to be a competitor because it was sanctioned oil. And I guess the issue for Alberta and the rest of Canada is that they have only one. So a lot of the oil, at least, they have only one buyer, the U.S., because it's basically landlocked. Is it called the Trans Mountain Pipeline? I can't remember now. So I think there's a lot of work. Maybe I guess you know more about that to be able to bring Canadian oil to the world market, not just to U.S. Refiners. But so far, do remember that Canada export roughly 4 million barrels per day, I guess it is, to the U.S. And on a good day, Venezuela may be able to sell some 800,000 barrels to the U.S. and it may not all go to the U.S. Canada will still by far be the biggest supplier of heavy sour crude slates to the U.S. But of course, it is another competitor. But I guess it's important for Canada also for other reasons not to be too dependent on the U.S. here.
Yeah, definitely. There is a lot of actually political talk going on here in Canada to build a pipeline across the coast to coast so that they can diversify the market for themselves.
Yeah, exactly.
Yeah.
And actually, you can say, where does China buy their heavy sour crude oil? They could buy it in Canada, they could buy it in Mexico. So you're probably in a situation where some of the heavy sour crude will actually now end up in China because they will be missing the oil from Venezuela, and maybe in the future also some of the heavy sour crude from Iran. Let's see what happens to if there's going to be some kind of oil embargo.
With a lot of heavy crude, Arne, coming to the market, and there's only so much refining capacity, I guess, which can really process such heavy grades of crude. Could you, to the new listener, just explain the basic economics of Nelson complexity and what kind of refineries can really make use of this heavy crude from Venezuela or Iran?
But it is basically the refineries on the U.S. Gulf Coast, and it's if I remember correctly, mainly the so-called teapot refineries in China, where they have built up quite a bit of capacity over the last couple of years to exactly take in these. I don't know why it's called teapot. I think it's because it's small, independent refineries, and I could also imagine they may not run under the same sort of environmental standards as you see in the big government-owned refineries. But that's basically where you can really handle this type of oil and get the best out of it. I guess most refineries can use it, but then there will be a lot of residual oil left. But I think looking at the high sulfur oil market is actually a very good indicator of what the market is saying. And the market is saying that there will be more oil available now for the global market because prices are going down. And when I say prices, we look at the so-called crack. It's basically the difference between what's the Brent price and what's the price of the product. Normally products have a higher price, right? That's what you earn in the refineries, like gasoline, diesel, jet fuel. But especially some of these fuel oils, they actually trade with a discount, and the discount has grown since since Venezuela. But yes, that is basically. I don't know if you have anything to add here, but I think it is China and U.S. Gulf Coast that are the main sort of.
So you covered the impact on the general world with the Venezuela oil. What I want to move towards is like more because you're based out of Europe. So how it's going to impact the European markets, particularly with the Venezuela situation right now evolving. How do you see that, especially given the fact that it's a high sulfur fuel oil? How is it going to impact the European fuel market?
I think we are already seeing the impact. There's simply more non-sanctioned fuel oil, non-sanctioned oil in the market because Venezuela has changed its from being sanctioned to non-sanctioned. So we are seeing fuel oil prices being under pressure, and we see good availability, and it seems to also have spread into the what you call the VLSFO, the very low sulfur fuel oil, which has a sulfur content of 0.5. This is the high sulfur is 3.5. So it has a downward pressure on prices relative to Brent. So a more negative crack or a bigger discount.
Okay. Arne, when I joined this industry more than a decade ago, there was a lot of talk about energy transition, still is. And but even today, oil remains critical to the global economy. Wanted your view on that. So how do you balance the energy transition narrative with the continued relevance of oil and fuel oil markets over the next decade?
I think I say a few words about what we have been doing in the group I work for, which are big in the bunker fuel market. We put a lot of effort into to new fuels, especially biofuels. And biofuels is pretty good for the bunkering industry because you can basically take biofuels, biodiesel, and use that instead of gas oil, which is a kind. It's basically fuel for diesel for the bunker industry. So and there are new rules in Europe, in EU, that you have to use a certain amount of new fuels. A lot of companies are also outside the EU are adding more new fuels. So there's a growing business. There was this IMO convent last year, and the plan was to sort of do a global phase-in of new fuels, but that was delayed 1 year by the US, and it will probably never come into place. Fuel oil, ordinary oil is here to stay. I think where we're seeing bigger demand is in the industrial chemistry industry, but I think over time you will actually see that the gasoline demand is going down. The EV revolution is quite heavy, and if we look 5-10 years ago, I think we'll be surprised how few normal cars will be be on the road because they will simply be cheaper. They will be cheaper to run. They're cheaper to repair and so on. And we see it. We see it in China. How many EVs are on the roads? We see it here in Northern Europe, partly due to tax reasons, but prices are coming down for EVs. EVs for trucks will come. LNG trucks. LNG in general, also in shipping, is already big. Will continue to grow because this has a lower carbon footprint and it's also cheaper to use. So a lot of the new ships that are being ordered are actually what you call dual fuel ships. So you can run on traditional bunker fuel, but you can also run on gas LNG.
Great. So, Arne, there is always a volatility versus resilience debate. Okay, so between sanctions, changing economics, and demand patterns, and also like fuel oil market appears to be at an inflection point. So, what do you expect European fuel oil markets become? Are they going to become more volatile or more resilient in the coming quarter?
In the coming quarter, I think we will see quite a bit of volatility in the so-called cracks, the price relative to Brent. There's a lot of things coming. We have the high sulfur fuel oil we talked about. We have here in 1 week's time there will be a ban on products, including marine gas oil based on Russian crude if it's been refined in China or India, which are the big refiners of Russian-based crude. That will be illegal to. There'll be a sanction that importing that into to the EU. That could create some volatility, and of course there are also things happening on the demand side. Where's the global economy going? There are some weaknesses, especially in the US. How the tariff is going to play out? What's happening with the Suez Canal, the Red Sea? Will it be reopened? And so I guess we will see volatility, but I don't think we'll see that the flat price moves a lot, but it will be relative to Brent, and especially marine gas oil, which is equivalent to diesel, is of course very dependent on what's going on in Russia in respect, not because the diesel is exported to Europe, but it has an impact on the global market. And it seems like Ukraine has some success taking out Russian refineries that are producing the diesel. So I guess we will see that Russia will export less diesel to the world market this year than last year.
Arne, thank you for joining us. It was such an insightful and practical perspective you provided us. I had a pleasure of having you at the Learn ETRM podcast.
Thank you.
Arne, really, you were able to explain to me, for me at least, in such simple words to understand what's happening, because it's so complicated to keep track of so many different things, and you also have a job. But thank you for making this sound like a story. Actually, it was quite interesting. And now the pieces are making sense to me. Really appreciate that. And thank you for being on the show.
And thank you for having me. And thank you for having a good knowledge, because it's always nice to talk to people who actually know what they are asking about. Put a lot of, thank you for that. Okay,
Yeah.
thank you.
Thank you.